Thanks for tuning in to the Learn Like a CPA show today, guys. We have a special guest coming on, so it's going to be Billy Withers. He's a fellow tax nerd, and we're going to dive into all the different types of tax strategies that we use for hundreds of our real estate investor clients. And I cannot wait to get started on this. He's actually going to probably teach me a thing or two that I don't know. So without further ado, let's get right into the episode.
Hey guys, before we get into the episode today, I really want to shout out my Facebook group, Tax Strategies for Real Estate Investors. So we have over 5,000 real estate investors in this group from all walks of life. We have long-term rentals, multifamily, mid-term rentals, short-term rentals, commercial properties, syndications, and everything in between. We have people that are co-hosting in there. We have people that are property managing in there. So make sure to join today because we talk about all sorts of things between tax strategies and real estate management, portfolio management, and absolutely everything you can imagine. So if you have questions for me, this is the easiest way to get access to me is to join this group and ask your question. So without further ado, let's get into the episode. Welcome back everyone to the Learn Like a CPA podcast. I'm super excited today because I get to bring on another tax nerd to the show. And so today we have Billy Withers with us. Billy is also a real estate tax strategist, and we've known each other for a while now, but recently kind of got connected. Actually found out that we live nearby each other, so we've been attending some of the local Chicago real estate meetups and just super excited to spread our love and knowledge of the tax code to investors everywhere. And so I'm glad to bring on to the show Billy.
Thank you, Ryan. Yeah, I've been helping real estate investors for over 10 years. I enjoy saving people thousands of dollars in taxes. I make it my moral mission so that everybody's paying as little in tax as possible. So I've loved, connecting with you and riffing on that, and excited to be here today to talk more about it too.
So that's your vendetta, right? Is just
yes.
Save as much on taxes for investors. That's important too. Is I saw Amanda Hahn speak one time, and she said that the tax code is basically a roadmap to wealth, and if you think about driving on that road, what is stopping you? It's typically like tolls and gas stops and having to pay all these fines and stuff. And I see the same thing with real estate investing. A lot of investors are not thinking about the tax burdens that come with whether it's fixing and flipping or selling a house, or we even talk about refinancing proceeds and whatnot. So can we give everybody listening a little bit more about your background? Kind of where did you start working at, and what do you do now?
Definitely. So I started my career here in Chicago and been working with real estate investors pretty much the whole time. I went to a real estate boutique firm in Charlotte, North Carolina, and worked there for a few years, right around when the tangible property regulations came out. And then shortly after that, I went to work at the Real Estate CPA. I was there for quite a while, helping the team grow and learn more about the tax code like I know, and decided to go off on my own here recently. So,
yeah, and because the Real Estate CPA is definitely a big firm that niches in real estate investors. So, as you guys kind of grew and scaled, did you notice any sort of common trends with your clients? I guess the clients that you saw in the beginning stages of the firm versus kind of later on.
Yeah, I would say that as we learned more about how to run a business and grew and things like that, the thing that we really realized is that, like you said at the beginning, with real estate investing being a roadmap to wealth, we were able to watch people go from one property to several properties to real estate professionals doing it full time, and seeing people walk that roadmap has been very interesting to watch in my career, and I really enjoyed helping people do that and achieve that.
Yeah, in a very short amount of time, right? I mean, because I've even worked with people over the last 2 years where they've gone from their first property to 8 in 2 years, and just millions of dollars of equity being built in a matter of just 2 years. Like, is there any person, and I know you can't say names or anything, but is there any client that you think in your mind that kind of sticks out?
Yeah, and actually, a client actually emailed us once and said, "Thank you so much for all the help that you were able to give us with the tax knowledge in order to be able to become real estate professionals and quit my 9-to-5 and to do it full time."
Wow.
And yeah, we've had clients like that. We've also had clients. One of my favorite clients was a guy who he had a small business. He made the minimum amount of money to invest in real estate, and then just spend the rest of his days traveling the world because his duplexes and fourplexes paid for his lifestyle. So working with those kinds of clients who understand and are willing to implement the knowledge and the things that we teach them is just really awesome.
Yeah, that's. I want to keep the conversation on clients a little bit. So, one of the things that I try to do in my firm, and I've actually gotten a lot of feedback recently from clients in there. Some of them are appreciative of it. Some of them are also kind of like drawn back. They're like, "Well, hey, aren't I paying you? Isn't that your job to kind of deal with that?" But one of the things that I do at my firm, and I know that you guys used to do it at the Real Estate CPA, is really focus on that education of the client. And so whether that's through, hey, we were talking about this strategy today, but I wanted to give you this full-scale podcast to talk about it, or we were talking about this type of idea here. Here's an informational handout material on it. Some people are kind of drawn back from that. They're, hey, why do I have to go through this? You should just tell me. But then also some people are super appreciative of, thank you for educating me and kind of letting my knowledge take its course, because I think some people will come to us and some people will just pay the fee to work with us, but they don't actually want the education. They just want us to do it for them and tell them, versus the investor, I think, that comes to us with that eagerness to learn the knowledge and absorb it, because I do know that clients that are going to be super successful as far as their knowledge of the tax code, and then there's the ones that just kind of get on the call and go through the motions. Did you see that in anybody?
I would say that the clients who are the most successful are the ones that were able to really work with us as a partner and understand the tax code alongside, take our knowledge and learn how to implement it in their business. Even right now in my current firm, I tell every client we're going to partner together. And it's not, yes, I can do the work for you, but you're going to get the most out of it, the most value of it when we partner together. And those are the clients that I prefer to work with. Just because I know how much value I can add to them, and it's rewarding to me in turn. That when we partner together and make sure that they understand the education piece. At the end of the day, the worst thing in my mission to help save everybody tax dollars is when the accountant comes in after the fact and says, well, you should have done it this way. That's the worst case scenario for any real estate investor. You have to have that partner in your business that understands the tax code, helps you walk the roadmap, and gets you to where you want to go in terms of tax savings to build wealth.
That Monday morning quarterbacking is what I call
exactly.
it.
Exactly. Yes.
So let's talk a little bit about that, because I think one of the things that the Real Estate CPA you guys started doing, and even the Amanda Hans and Anna Karina, Matt Bontrager's firm, and then my own firm, and then now your firm, is we're really trying to make that separation between a tax preparer, somebody who's just going to file your tax returns, and then an actual tax advisor, somebody who's going to walk with you through the year to actually be there to help guide you and advise you on strategies. And so, unfortunately, a lot of people still think that person is the same person, and it could be, right? You could,
yes.
At my firm we do, and I think your firm does too. We still do the advisory and the prep, right? But they are separate roles, and so I think that's one of my missions is to just get people to kind of understand those differences there and what they're really paying for. Because how many people come to us, January, February, hey, this is what I did last year, can you help me save me money? And it's well, sorry, you're actually kind of too late.
Yes.
Yeah. There's really nothing you can do. There's some things you can do after the year is over, but very few.
Yeah, we were actually just talking to a prospect this week that said, I don't think I want to commit to an ongoing consulting engagement. And we said, that's fine. And then as soon as they said no thank you, but signed their tax return engagement, they said, okay, now can I do all these strategies? And it's well, it doesn't really work that way. I have to teach you how to do it, and then you have to do it consistently. And then, at the end of this year, then you'll get the value out of it. And so, yeah, I think we have a long ways to go to try and educate clients to be a little bit more proactive in themselves, even though we have all these tools to try and help them be proactive as well with these, consulting engagements ahead of time or content that we put out, things like that.
Yeah, and so let's talk about one of those strategies. So cost segregation has especially been huge the last year. So ever since TCJA and Trump overhauled the tax code and allowed 100% bonus depreciation, it has probably been, in my opinion, the eighth wonder of the world, a real estate investor's best friend, because you can get 100% at one time from 18 to 2022?
Correct.
You could get 100% bonus depreciation on any 20-year or less property, right? So typical building, you're depreciating anywhere between 20 to 30% of the building's value in that first year, massively accelerating the depreciation on it. But as you and I know, that has to be paid back one day, right? And there's certain strategies that you can do to mitigate the depreciation recapture, but overall, all that is doing is it's an arbitrage sort of time value of money play. Even if you're to say you get the tax break in year 1 and you pay it back in year 10, even if it's the same going in and out, you're still taking advantage of that interest for your loan.
Right.
What are your thoughts on accelerating the depreciation even if you have to pay it back?
Yeah. So, I think every investor is different. Part of the reason why you work with a tax strategist is so that you get them to understand your investing goals, and then you help them lay the roadmap, or they help you lay the roadmap that you want to walk. So you have options when you have a cost segregation study, because you can depreciate everything up front. You can elect out of bonus depreciation and just take things over a shorter time window, which still helps you on the time value of money play. And then it also gives you information to have, down the line if you ever need to know what your different components are worth. So really, having a cost segregation study is just a tool that everyone should take advantage of. And then you have a conversation with your tax strategist on, do I want to accelerate the depreciation all up front? Answer is usually yes, but it's the conversations that it sparks and the information that it provides that really makes it worth having in every investor's back pocket, basically.
Yeah, and that's one of the things that I do is sometimes I'll get on calls with people and I'll just listen for a while. We'll listen and then just probe and ask questions, because a lot of times investors will come with a specific question. Hey, should I do this? Should I do that? Or I was thinking about this, but I'll fire back 3 or 4 questions to somebody before I can actually come up with an answer, because everybody's situation is a little bit different. And so I would like to talk about what are some of the green lights, check the boxes of when somebody should take that 100% bonus depreciation, and then when they probably should wait.
Definitely. So one of the green lights I would say is if you sell a property in the same year that you purchase a property and somehow did not do a 1031 exchange, a cost segregation study with all of the depreciation up front is a huge benefit, because all those passive losses, if they're passive, go into the same bucket and offset one another, so that you can, essentially use the new property's depreciation to offset the old property's gain. I would say a red light would probably be where people don't need the depreciation, right? That's where, they're just starting out. They are not a real estate professional. Maybe they came to us a little too late and we're talking about the prior year. It's still good to have a cost segregation study, but maybe we elect out a bonus that year and just let the components depreciate over a shorter life, so that as the property stabilizes and begins to receive cash flow, it'll still have that, tax advantage potentially. So those are 2 examples that come to mind off the top.
Yeah, that's something that you bring up that I think was important, is your situation, right? If you're kind of just getting started, you might be in a lower tax bracket than somebody who's been a seasoned investor. And so, I kind of throw out in some of my previous podcasts and even in my courses and trainings of kind of an arbitrary tax rate amount of typically about 22% or more, 24% or more, where if you're in that bracket or higher, it probably makes sense. But if you're lower, then you kind of have to do a double take, because one of the things you may not want to do is accelerate the depreciation when you're in a 10 or 12% tax bracket. And I think back to one of the clients that I had in 2021 who, I don't even know how he was able to do this, but he had a W-2 and he made $40,000 as a W-2, and he ended up buying 3 cabins in the Smoky Mountains. I have no idea how he qualified for the loans, but he did cost segs on all of them. And he was expecting, hey, this cost segregation company told me I was going to get all this money back and $100,000 refund and whatever, and I didn't get anything. And I had to explain to him, you didn't pay anything in withholding. Your tax bracket is 10%.
I think those cost segregation companies assume that you pay 35% usually.
Every single time, 37 or 35.
Yeah, they give you the quote.
Yeah. So to kind of go a little bit further, so doing the cost segregation study is one thing. Mm-hmm. Maybe you have lots of rental income or lots of gains, but let's say you're scaling your portfolio and you're not really looking to sell. One of the things to pair a cost segregation study with is to be a real estate professional, so real estate professional status. And so there's a lot of, man, I just see so much misinformation, I think, out there of does it mean to be a real estate professional? Who needs to be one? And, my wife just got a realtor license, so, hey, she qualifies as a real estate professional, even though she's, maybe she doesn't have a full-time job. It's let's kind of talk about real estate professional status and how we've kind of seen clients use it to build wealth.
Sure. So I'll start off kind of with the common misconceptions, like you're saying. They either think that they materially participate in the rentals, so they're good to go. They're a real estate professional. That's definitely not the case. And then also on the flip side, they think that they're a realtor, they're automatically a real estate professional. That's not the case. You have to have your 750 hours in a real property trader business, and then you have to materially participate in the rentals as well in order to qualify. But kind of going back to what I was saying, where clients are so appreciative when we help them with the real estate professional status, they're able to avoid taxes when they become a real estate professional by buying rentals, scaling their portfolio, and then at some point they get to a point where they haven't paid any tax. They've been able to reinvest those dollars back into their business, and now their rentals are supporting their lifestyle, and they can do whatever they want with the rest of their time. They can continue to be real estate professionals. They can travel the world. They can do a mix of both. And obviously, I think a lot of people would consider that to be real wealth, with the rentals paying for their lifestyle and getting to choose how they spend their time the rest of the time.
And what is your typical client, who does qualify as a real estate professional? What does their day-to-day kind of look like, as far as what do they do for their primary occupation and then their rental portfolio?
Yeah, good question. So I would say a lot of clients do enjoy being realtors, or I've worked with a lot of commercial brokers as well. And so I think just kind of connecting people and spending time looking at properties, things like that, that's a pretty common way. Syndicators, obviously, along that vein as well. I would say those are the two most common, real estate professional, because you get your 750 hours in a real property trader business. And then, as you're looking for deals and just going in your normal course of business, you find real estate deals that are worth, locking down for yourself and adding them to your portfolio.
And so, let's a little bit about the misconceptions. So it's 750 hours in a real property trader business, and then it also has to be more than half your working time. So even if you do get your 750 hours in real estate, you still have to prove that that's predominantly what you were doing for the year. So if we're both run accounting firms, and let's say we spend 2,000 hours a year, we're going to have to spend 2,001 hours in our real estate, which is probably not going to happen. And so, real estate professional status, but let's kind of go back to what is it actually for? Well, it is for people who are dealing with long-term rentals, multifamily housing, perhaps midterm rentals, commercial properties. We kind of seen it, at least I've seen it the most, with kind of single family homes that are long-term rentals. So I have two clients that really stand out to mind, and they're on both ends of the wealth spectrum, let's just say. So one of my clients is from Arizona, and he has a real estate brokerage firm. He's an agent, and he probably makes about $250,000 a year as his primary occupation. And then he'll buy 2 to 3 single family homes as rentals. And for the last 2-3 years, he's been able to offset all of his W-2 tax by buying the properties and qualifying as a real estate professional. So on one end, he's saving anywhere between $60,000 to $80,000 a year in taxes by implementing that strategy. But then I also have another client, really big client, who actually was a former NFL quarterback and is now kind of still working with the NFL and the sports networks. But his wife actually qualifies as a real estate professional. So his wife is in charge of managing their long-term rental, commercial, midterm rental portfolio, and he's still making a couple $1 million as a analyst, anchor, whatever you want to call it. And so they're able to offset a significant amount, not all of it, but a significant amount of their his W-2 income, because the wife qualifies as a real estate professional. And that's really important, right? Because you need one person to qualify as a real estate professional, but both spouses can actually count their time towards that material participation component.
Definitely, yeah. That calls to mind for me doctors as well. Doctors is a case where we also see the real estate professional status because their spouse is able to actually be the real estate professional, and then they apply the tax savings of being a real estate professional to their W-2 high earning income.
Yeah.
Software would be another one too.
It's kind of funny because I remember in the beginning, before I started publishing a bunch of content and just kind of, training and material in that, I would explain real estate professional status to a doctor or a lawyer or somebody. And they would just look to their wife and be like, "That's what you're gonna do."
Yeah, you got it. Yep.
and then you could just see the wife just shaking her head. She's like, "No, I'm not gonna do that." But they're so adamant about having their spouse qualify as a real estate professional, so that way they can offset their high W-2 earning salary.
I always ask that question: is are you sure your spouse is on board? And 9 out of 10 times the answer is yes. But there's always that other 10% that you go, I'll get him on board. I'll bring him around.
And I think one other thing about real estate professional status that I actually discovered multiple errors in returns last year where there would be a taxpayer who may not have rentals, so they do not have or they might have sold their rentals, so they may not have enough hours for material participation, but because they work in a real property trader business, so let's say a real estate agent or a fix and flipper, they qualify as a real estate professional. And so one of these returns that I was reviewing, they had about $130,000 gain from a sale of a property. They didn't materially participate in the property, but the wife was a real estate professional, and the prior tax preparer CPA did not mark her as a real estate professional, and so because of that, it taxed them on the net investment income tax. So she paid about an extra $5,000 in taxes because the prior accountant didn't know to mark her as a real estate professional.
Yeah, that would be an unfortunate situation, and where you'd want to work with somebody who's niched down and really understands the ins and outs, because that's definitely something that we look for as our quality control process to make sure that that doesn't happen.
Right. Anything else on real estate professional status that we didn't touch?
I think we covered about everything.
Okay. So kind of go into, and this is really, I've probably spent the last year or so focused in short-term rentals just within like my own investing portfolio and kind of, my clientele, but then also just the people that I've been networking with. I spend a lot of time in multifamily and things like that, but short-term rentals have been kind of like my bread and butter the last year, more specifically the short-term rental loophole. So, I talk a lot about the short-term rental loophole, but I'd love your take and explanation on it.
Definitely. So I've been taking advantage of this for clients for quite a while, just kind of understanding the ins and outs of what is passive versus non-passive in this arena.
You don't have to be a real estate professional.
Right, yeah.
7 days or less average.
Right.
Yeah.
Anyway, the short-term rental loophole is great because it allows you to realize the benefits of being a real estate professional without being a real estate professional, and you have to really help clients understand that because they sometimes think it's all the same, right? Oh, I'm a real estate professional because I have short-term rentals. That's not how it works. It's very different, and it's very crucial to work with a tax strategist who understands the ins and outs like you do so well and explain so well, because you could find yourself in a situation where if you don't talk enough with your tax strategist, it might be, again, one of those, we'll have to go back and fix things, or, the results won't roll up the way that we expect them to. Another thought on that was, you can still use the cost segregation studies for your benefit, and just as you would as a real estate professional. But again, you got to understand the differences between being a real estate professional and having short-term rentals. The last thing that I'll say about this topic too, that I always talk with clients on, is the margins on short-term rentals are so good that if you take all the depreciation up front, next year you're probably looking at a tax bill. So we always make sure that we have a plan to mitigate that, whether it's, investing in passive and income or loss streams in the future to offset that, and taking a step back in the business, or continually adding to your portfolio so that you can continually add the gains. You got to look past the next year, because once that short-term rental stabilizes, the margins on them are so good that you could be looking at a tax bill that subsequent tax year.
Mm-hmm. Yeah, I think that's a big thing, especially what I've been kind of talking about lately, and kind of, in my training and even in this new accelerator program that we have with the STR Super Team, we talk about, mapping out your sort of like your 3-year, 5-year, 10-year goals, because, the decisions that you do today have to reflect where you want to be in those years. So, if you accelerate depreciation on a property, and especially if it's a short-term rental, like that thing's going to cash flow like crazy. Maybe not the first year because you have all your setup costs and you're getting it going, but once that thing's live for an entire year, you're going to have substantial revenue. And if you've taken the cost segregation study in the first year, you're not going to have that much depreciation to carry forward for years on. So you really have to strategize about what you're going to do with that. I think when I explain it to clients, I always use the hot potato analogy, where it's, hey, if I have $100,000 of net income from my property and I'm in a 40% tax bracket, well, if I don't redeploy that $100,000 into either other rentals or syndications or whatever it may be, I'm going to expect us to pay $40,000 on that.
Definitely, yeah. I would say, put another way, if you're going to go talk to a tax strategist about the short-term rental loophole, you should expect them to come back with you with a longer-term plan than just the right now in the first year, so that you guys can work together and partner together to talk about the tax implications beyond year one, because they could come back to bite you in that hot potato scenario.
So you'll never hear me say the word loophole, but I only say it with short-term rentals because I do think it literally is a loophole. So a lot of people will say, oh, a 1031 exchange is this loophole, or this is a loophole, or like write off your travel is a loophole. No, none of that's a loophole. It's all built into the tax code. But the reason why this is because if you really look into Section 469, where you find real estate professional status, it does have a specific carve out for if your property, if your rental is rented out for an average of 7 days or less, it's not actually a rental activity for purposes of Section 469, which means you don't have to be a real estate professional in order to take a short-term rental loss against your W-2 or your business income. You just have to materially participate like you would if you were a real estate professional.
My take on that is, the IRS loves their arbitrary numbers. One of their arbitrary numbers in this case is that 7-day bright line test. And to me, what that means is, there's roughly, 4 weeks in a month. So, if you're collecting rent more than 4 times a month, which would be every 7 days or less, they say that you're non-passive basically in that activity. That's my take on it. And that's why I think it really is a loophole, because somebody didn't think to say, okay, so what happens, or how should we limit taxpayers to taking advantage of this if they do collect rent more than 7 days? So,
I also think about when they wrote the law, when they wrote the rule, they were not thinking, at the time it was a lot of like property managers and larger scale operations renting out, resorts and kind of areas, hotels and stuff. And they weren't really thinking about, you and I having our lake house and renting it out, right? So I think, we'll see as this kind of gains more popularity, and, we'll see court cases and audits on this and stuff. But, it says it right there in the code, right? 7 days or less, it's technically not a rental activity. It's a business. It's just like any other business. And so we'll see like what kind of, I guess, sheds light to it. But, in the time being, it's a substantial wealth building opportunity. I mean, I look back in 2021 and 2022 at all the people, and, if you're making, let's say, married $250,000, $300,000 income, and you buy even a $500,000 cabin in the Smoky Mountains, an average client was saving $30,000 to $40,000 in taxes utilizing this strategy.
Definitely. I think it's been a huge boon for those high wage earners who are able to take advantage of it. And I hope that we see it continue, although, the winds of change are always blowing. So we'll see.
So we'll move on to something else. So you did a lot of, I remember actually I sat in on one of your guys' tax and legal summits one time.
Yes.
I can't remember when it was, but you guys, at the Real Estate CPA, you guys would kind of bring in some attorneys and bring in some experts, but then you guys would also put on your own thing. And you actually did an event kind of like on some bookkeeping topics and some depreciation schedules, and so some of the stuff that you commonly see investors miss. So what are some of the missed deductions? Not what we're going to talk about later, but what are some of the common missed deductions that you see, in clients like books and records, I guess, especially like DIYs?
Definitely. So to me, the best way to summarize it is when you don't have any books and records at all, right?
Yeah.
You don't know what to put. You don't know how far to look back. You don't know, where to look, things like that, if your transactions are all over the place. So really, when clients start up with me, I really harp on the fact that you need a separate credit card, a separate bank account, and then some kind of accounting software to make sure that you are capturing everything appropriately. Especially now, clients tell me how much they love using Stessa.com as their bookkeeping for their rentals. And to hear non-accountants say that they love an accounting software is just so strange to me. But it's been so good for these people because you need to have an accounting system to capture all of your deductions, because the ones that I mostly commonly see missed, to answer your question, are the ones that just aren't captured whatsoever. On top of that, I would say that anything the property manager doesn't capture in their accounting software is the ones that are most commonly missed. Clients don't know to say, oh, where's my LLC fee here? Where is my time spent on my cell phone? Can I deduct any of my cell phone expense? Unless you're having really in-depth conversations with your tax strategist, those things don't come up because those are the kinds of transactions the property manager doesn't capture for you.
Oh, so you're saying if, let's say, a client has a property manager, they send them their little report at the end of the year, they're probably going to miss a lot of deductions because they just take that report and they hand it to their tax preparer. Yeah,
Yeah, the property manager catches the maintenance. He catches he or she catches, maybe he'll help you with the mortgage, but by and large, it's just maintenance cost and their property management fee. And a lot gets missed because you only use the property management reports.
Yeah, let's talk about that mortgage piece of it. So, like we know that when you have escrow, typically you're going to escrow your mortgage interest, your insurance, as well as your property taxes. And the principal payment we know is not deductible, but those other items should be. And so, one of the common mistakes, or I guess one of the mistakes that I saw actually before I even worked at Deloitte, but at a different CPA firm, is we had a client that had a commercial rental, and they had about a $50,000 a month PITI payment on this particular property, and they hired in-house bookkeeper, kind of somebody's my friend's mom or dad studied accounting, and what the bookkeeper was not doing was she was actually the entire time for $50,000 she was booking that $50,000 to loan pay down and equity pay down. And so she wasn't breaking that out with interest, taxes, and insurance. And so, the client ended up the client missed out on, it was somewhere about $200,000 of deductions for that year because they were booking everything to that equity pay down instead of breaking out the interest, taxes, and insurance. And the way that we were able to catch it was just seeing that the balance on the property was too low at the end of the year compared to the bank statement.
Yeah, your accountant should be asking you for your mortgage balances at the end of the year end to help you with that. I usually see it the opposite way, where the clients will try and deduct all $50,000, which you can't do unless you have an interest-only payment, right? And then you can. Yeah. So that's why you should really be working with an accountant very closely to partner with them to help them understand, your debt situation. If you have an interest-only loan, something like that, maybe your payment is entirely deductible. So, yeah.
Yeah, I've seen just mortgage, people just lump it up. They don't break it out between interest, taxes, and insurance. What about like cost on a closing statement or a closing disclosure? Like, do you see that get missed a lot?
Yeah, so I was actually looking at somebody's books the other day, and I saw that on their balance sheet was nice round numbers for their asset purchase, which we know is probably never the case. Usually you have to figure out what closing costs are includable in your building basis, what loan fees are amortizable over the life of the loan, things like that. So yeah, I guess that's a red flag that your accountant should catch, would be if there's round numbers on your balance sheet, that's your closing costs were probably not accurately captured, or they were currently deducted, which is probably wrong. So,
is there any other kind of like strategies? I'm a really big fan of like the Section 121 live and flip. That's where you occupy your primary residence for at least 2 years. You can at that point convert it to a rental for a little bit and then sell it, and you can get all those gains, capital gains, tax free. That's one of my personal favorites. I'm a big fan of the paying your kids strategy in your business. Is there any other strategies real quick that you like to use a lot?
I love, like I said, having the cost segregation study, even if you're not using bonus depreciation every single time, because it just gives you so much information that is valuable to your tax preparer, who's ever preparing your tax return. Because, I think one of the things we're going to talk about today is the partial asset disposition. That's another one of my favorite strategies, because clients come to me all the time and say, I invested in this new roof, I invested in some other structural repair, I want to write it off. Well, you don't get to write off the new structural improvement, but you can write off the old structural improvement when you place the new one in service, and that's basically the essence of partial asset disposition.
Yeah, and what was really interesting is I remember when I first kind of started learning about partial asset dispositions, it was actually the way it was brought up was that is the thing that actually saves real estate investors the most money out of their investing career, is this idea of being able to, if I have a house, right, and I'm depreciating it, and I replace the roof, well, if I just add the roof on and depreciate the new roof, I'm depreciating two roofs at the same time. So can you explain that a little bit, because that's something that we've implemented at our firm, is to kind of go through and look through for partial asset dispositions. But can you take it away and kind of explain?
Definitely. So the roof analogy, in my opinion, is the best analogy, because you have a roof when you purchase a property, more likely than not. maybe it's a good enough roof for another couple years, but when it comes time to replace the roof, that is a structural component on a property that needs to be depreciated over 27 and a half years, right? So it doesn't qualify for that bonus depreciation like we've been talking about. So when you invest in your property and put the new roof on it, you can't take accelerated depreciation on the new roof because it's a structural improvement. But what you can do is determine the value of the roof that you initially purchased. And there's a couple of ways to do that, cost segregation study being the best way. And then you can basically write off whatever remaining basis in that roof that is old that you're throwing away. And what that allows you to do is recoup most of your investment in the new roof in terms of, say if you put a $50,000 roof on it, you can take maybe, say, a $35,000 deduction for throwing away the old roof. And the process of doing that is called partial asset disposition. So it's a really powerful tool, like you just said, because even though you have to depreciate the new one over a long period of time, you do get some instant recoup of your investment when you throw away the old one once you properly ascertain the value of the old roof that you're throwing away.
So I have a few questions. So number one, when you remove the old roof off your books, that's an expense, right?
Correct. Basically, you take you're taking a loss on it. You basically sold the asset, quote unquote, for no value, and so it's zero gain. Zero proceeds with whatever you determine the basis to be, and that basically is a negative transaction. That's an expense on your books.
And that shows up on what line of the?
Basically, you should be looking for those on your 4797 form in your tax return.
Wow. Okay. See, I learned something today.
There you go.
Okay, then I think the other question I had is, let's say you bought a property, you didn't do a cost segregation study on it. Maybe it was a property that you bought a few years ago, and you do put on that new roof. Is there a way to do the partial asset disposition without knowing what the value of the old one is?
Yes, and it's a little bit hard to do, so you need to work with somebody who knows what they're doing. But essentially, you can look up the value from basically government mandated values. I forget the exact name. But the government puts out information that helps you value the cost of the old asset that you purchased to kind of give you an estimate of what that old roof might be. I think, basically if you were to look up what were roofs worth 5 years ago, and the time that you've owned the asset is 5 years, then it's an appropriate way to say that old roof was worth X and my new roof is worth Y. So you can figure that information using the government statistics that they publish to arrive at that without using a cost segregation study.
Mm-hmm. Yeah, and I've never talked about a partial asset disposition on the podcast or I think anywhere in public. It's like such an advanced topic, but one of the things that really comes out to strikes me on it is you get to expense the old asset. Let's just go back to the roof example. You get to take that as an expense on your books, which is an immediate tax deduction. But more importantly, because you've taken a loss on it, essentially, you don't have to recapture the depreciation.
Definitely. Right? Yeah, and so it's less basis. When you have two roofs, you have more basis, which would down the line maybe save you some money. But we like to get people to save money today, time value of money, as we always say. So, I just think it's a great way that clients get to recoup their investment immediately by depreciating or expensing the old roof, even though they can't take accelerated depreciation on the new roof. Or whatever asset we're talking about.
And I think I remember looking at like a partial asset disposition calculator online, and that's what I was reading too, is you can do them using those approved tools, but you really do want to have that cost segregation study to do it because it's just a lot more official. I know I had a client who bought a property towards the end of last year, October, November, and they had planned significant renovations and rehab. And so when I was talking to the cost segregation team, they were like, hey, this is a good idea let's go ahead and place the asset into service. Let's do the phase 1 study. Let's come in with the renovations and the repairs in year 2, and then now do a part 2 study, removing some of that stuff that we captured in year 1 off. And, just seeing like the tax savings, before and after was substantial.
I sleep much better at night knowing that the engineers took care of the valuation of the assets that we're disposing of for a partial asset disposition. Just because, if I go and try and figure your valuation for your asset, I may not be looking at the right assets. I'm a tax guy. I'm not an engineer that does this day in and day out. So I feel, going back to what I said about having the cost segregation study in your back pocket, having the engineering firm really value those components that you're going to go dispose of down the line once you do those renovations is just it's worth a lot more than what you pay for, because you'll know exactly, all the appliances in the building were say worth $5,000. When I go buy new ones, I'll be able to throw away the exact amount and get the exact deduction according to the cost segregation study.
So now I would say, is a partial asset disposition only on items with the class life more than 20 years?
So that's when it's most advantageous.
Okay.
In the with the advent of 100% bonus depreciation. If you've already depreciated assets, you're not depreciating two assets anymore, right? So if I have a piece of 5-year property and I expensed it in my first year using 100% bonus depreciation, partial asset disposition doesn't help me all that much.
Okay, sure.
There could be scenarios where you did not elect to take bonus. I've actually looked over a lot of returns lately where everybody elected out a bonus for whatever reason. Well, now they could use partial asset disposition if they go replace those shorter class life assets, because they have basis left over from those old assets, and they should be able to double dip. If I'm not mistaken, where they can take bonus on the new asset, write off the remaining basis in the old asset, and maybe double dip there too. But it's best used when the class life is over 20 years, because there's going to be enough left meat on the bone left, so to speak, to take advantage of the expensing the old asset.
Yeah, my wheels just kind of got spinning on that part where you can expense the old asset, potentially fully depreciate the new asset. And thinking of like strategies, like let's say you're somebody who's got a couple of houses, let's say 3 or 4 properties, short-term rentals, and you have all this income coming in, or maybe you have a gain on something, to be able to maybe time your repairs and renovations on some of these, older properties in that same year where you're also selling a new property. You can take your expense on your books as well as a new depreciation to help offset that gain without having to buy a new property is a big thing. Because especially now with like interest rates going up, a lot of investors don't want to park cash because they're afraid of kind of what the market's going to do with the economy. I think that's a great strategy. I just thought about that.
There you go. We got to come to you for all our tax answers.
Well, they'll go to you for any partial asset disposition questions, because I did know when I first learned about that was kind of like a wow factor to me. So yeah, thanks for bringing it up.
Yeah, it's something, again, on my mission to help everybody save their as much tax dollars as possible. It's definitely something you want to keep in your back pocket, and it really amplifies the value of having a cost segregation study, because we'll know, when the time comes, we'll know exactly what those components are worth without having to scratch our heads too much.
Awesome. So, Billy, if people want to get in touch, where can they find you at?
Definitely check out my website, www.summitats.com, or you can send us an email at hello@summitats.com, and we'll get in touch with you, and we'd love to have a conversation about, any tax-related stuff.
Awesome. Yeah, we'll link it in the show notes, guys, if you're interested, and we'll see you guys in the next episode.
Thanks for checking out the podcast today, guys. I mean, we talked about so much, right? We talked about real estate professional status, cost segregation studies, short-term rental loophole. We talked about other sort of tax strategies. And most importantly, we talked about the partial asset disposition. If you guys want to get in touch with me, go check me out on all social media platforms. It's going to be at Learn Like a CPA on Twitter, Instagram, and TikTok. And get in my Facebook group. It's going to be Tax Strategies for Real Estate Investors. We have over 5,000 real estate investors in that group. We're talking every single day about tax strategies. We'll see you guys in the next episode.